Good afternoon. See, we've got some folks that are coming into the room. Hi, Amy.
Hey,
All right, folks, welcome. We're going to go ahead and get started and respect your time. My name is Jason Friedman, and welcome to Eyes Wide Open, the path to creating a sustainable community development financial institution. Jason Friedman, the CEO, Friedman Associates, and I'm joined today by Amy Zabo, who is our Client Experience Officer. And Amy runs our certification compliance and capital access division. And so she's been pretty busy. And Nadia Dubiani, who is our director of client success, making sure that we are meeting on our promises to our clients to meet their expectations and needs. The webinar will be recorded. You will get the slide deck. You will get the handouts. No problem there. We have a Q&A pane. Please dump in questions as we go forward. This webinar is designed primarily for those of you that are in the process of either applying for CDFI certification, or you are currently a nonprofit lender seeking certification, or you're a nonprofit that's considering creating a loan fund that ultimately would be certified. But folks that are not yet certified, although I see we do have quite a few of those on here, so we're going to look forward to getting their feedback on the hard truth of building a successful financial institution. So we're going to go right ahead and jump into it. And today we're going to talk very briefly. This is a short presentation. This is designed to inspire some dialogue and questions, hopefully, maybe some debate, who knows. We are not going to be talking about CDFI certification, although we will be explaining what it is and what it is not. But the focus here really is on to be very clear about what exactly a CDFI is, what the business model for a CDFI is, what does performance look like, and whether you're public, private, or nonprofit, philanthropic sector, you believe that CDFIs have achieved proof of concept, right? It is a model that people see as a go-to. We're going to talk about the paths. There's different paths, strategic paths that you can take, and they're not right or wrong. And it all comes down to how you frame your identity and your mission and your purpose. But we are going to spend bulk of our time really talking about the operational requirements to be a successful CDFI, the capital structure. This is where we really get into the hard truths of what it means to be a community development financial institution. And so 30-second overview here. We are a 18-year-old consulting firm that focuses on building remarkably successful CDFIs that finance a more inclusive and equitable economy. We work with CDFI loan funds, both nonprofit and private, and we focus just on three things: financial sustainability, enduring capacity, and mission impact. And the way that we do that with a team of 20 professionals who have all been on your side of the table, from CEO on down, that's our value proposition. But we help folks get certified, onboard compliance, get access to funding from the fund. We help build and drive successful loan fund operations and help build them to scale using best practice tools and techniques. And we get under the hood to help our clients solve problems like diversifying our capital stack, being able to scale up to meet the demands of our funders and our public, and so many more things. And you can go to our website and look more about who we are. I'm going to try this here. If you folks go to menti.com, or you hit that QR code, or hit menti.com and use the code, hopefully you'll be going to a screen. And let's see, I'll share this screen. And do me a favor, just let me know if in fact you're able to access the Mentimeter.
It worked for me, FYI.
Yeah, okay. So who do you associate, just enter a word, what do you associate most with CDFIs? What words come to mind for you? And we'll see how people respond to that. All right. Okay. Which best describes, all right, we'll go back and we're gonna just let that go for now because Menometer doesn't seem to want to be cooperating, and that's okay. Let's talk about what a CDFI is and what it's not. Okay, this is kind of we'll go back to sharing on slides. Okay. Bottom line, CDFIs build economic equity by providing access to credit where it's most needed. I think those of you coming in that are new to this generally understand that as a baseline of what CDFIs do as financial institutions. And we focus on individual upward mobility and seed financing for what I call credit invisible individuals, folks that are credit worthy, but just outside conventional banking guidelines. And there are credit unions and consumer loans, individual small business loans, homeowners down payment assistance loans. And then there are CDFIs that focus on structural assets, affordable housing, building daycare centers, mixed use commercial hubs. And it's limitless in terms of your imagination about what is possible. It just depends on the market and your community and how you can come in and fill that gap. CDFIs are always looking for a way to say yes and to focus on long-term wealth building. What's really cool about this universe, this ecosystem, is that it's very diverse. And I don't mean just in terms of the fact that you have certain sector niches like micro and consumer lenders, small business lenders, and asset financiers. That's a very broad categorization. But the reality is that there are small, medium, and large. There are national CDFIs, regional and local CDFIs, and we want to talk more about the richness of that diversity and why it's so important to the future of the field. But the first thing I just want to just be clear about, because we're not talking about CDFI certification, which is really one of the most misunderstood designations out there that we've experienced working with hundreds of folks that want to learn about CDFI certification. So I just want to take a second just to clarify that, because folks are thinking, well, I wanted to learn about certification, and we will do that. We'll do that in our next webinar. What does it mean to get this technical designation? But the reality is that there's a real misconception and misunderstanding. Think about it this way. CDFI certification is like getting a learner's permit for driving. It doesn't say anything about whether or not you're a good driver. And I'm a good example of that. I got a learner's permit, but I'm still trying to figure out how to be a good driver. What a lot of folks, so it comes down to competency. When you hear about a board certified clinician, ISO 9000 manufacturing certifications, you think about a level of competency. That is not CDFI certification. CDFI certification is a baseline designation that proves that you were created specifically to bridge the gap between marginalized communities and the financial mainstream. It is, the reality is it's a stamp of approval in the sense that you have passed those minimum standards where you're behaving as a mission-driven lender. It doesn't mean that doesn't have anything to do to say about your performance and financial health. a lot of people think, well, that means that you're required to become fully self-sufficient and bank-like. And that's not true. You have an opportunity, you have a path to choose your own strategic pathway, whether that means financial sovereignty. And what I mean by that is some of the very largest CDFIs with diverse portfolios and markets, and that will be able to generate all, if not almost all, of their revenue from their fees and operations. To folks that have to depend on subsidy because they're working in specialized markets that require more support and technical assistance. There is no one way to do this. However, there are some we'll talk about what we believe some baseline minimum requirements, regardless of whether you see yourself as being a national lender or being the go-to in St. Louis, Missouri. It is another widespread misunderstanding is that there's a rigid framework where relying on grant funding means that your model is failing, because you should be scaling up and improving, growing volume, increasing net assets, et cetera. And the reality is that CDFI loan funds, by and large, are nonprofit organizations. That doesn't mean that they shouldn't be working towards creating economic self-sufficiency and building their portfolios and investing in performance. But the reality is that no one is suggesting that CDFI nonprofit funds no longer function in the marketplace as nonprofits, where they have to convince other people's money that they are doing good by giving their investment to you. The reality is it's a blended model that we're going to talk about, where operating subsidies are healthy, permanent, and respected fuel for deep impact. Again, we're going to be covering the highs and lows of CDFI certification specifically, but I say to folks that come to me and say they want to get certified as a CDFI and they've made a couple of loans and they've formed their nonprofit status, I would say to them, your goal is not CDFI certification. Your goal is to build a strong, healthy loan fund that can prove that it can take other people's money, get it out to where it's needed the most, manage it well, show financial health and performance, because that's what's going to bring in friends and neighbors and money from the public and private sector. You will get certified, you will meet the basic tests, but your mantra is we need to build a financial institution. And we'll show you what we mean by that. Now, stepping back, and again, for those of you that are here to learn about CDFIs, this is what the business model looks like broadly for loan funds, okay? Key features of the model, we're not going into the weeds here, but mission-driven lending, right? That's what differentiates you. Capital, risky capital for underserved markets, because you're addressing systemic inequities. Localized focus. You know your community, you know your people, you know the issues, you lived and breathed them, especially during COVID. And it's community-based organizations that have the superpowers to build that trust within the community and be able to be market responsive. It's harder to run CDFI than a bank. I'll just say that and see if anyone disagrees with me out there. We don't take deposits, right? So we rely on, again, on grants and loans, debt capital, equity capital, trying to get cheapest money possible, and to be able to structure flexible and patient financing. And because we're working in higher risk communities, the reality is that the superpower of this, the difference is our ability to support those entrepreneurs, those homeowners, those minority construction developers that are growing their businesses. We provide that support because it's not unlike a bank. You get a loan from a bank and they're like, hey, good luck, and you may be paying your note every month. That doesn't mean you're succeeding in business. With a CDFI, we're going to invest in you beyond just the loan. We're going to invest in your capacity to be able to reach your asset goals and wealth goals and create economic opportunity. And that costs money. Costs money to raise that money to be able to support those entrepreneurs. But that's what you do to promote sustainability. And you can see here the strengths and advantages of this model, right? I don't have to read them all off, but basically you see here mission driven, being responsive, especially as we saw during the pandemic, where CDFI is almost late in the game, were called in, stepped up, and got a tremendous amount of money out there and backstopped failing businesses. CDFIs are the missing piece of the capital stack. We have flexible, tailored solutions, right? And we are the bridge. The reality is the trade-offs there are significant in that it's resource intensive, right? We need specialized expertise, both as financial institutions and on the mission-driven side in terms of our programs. We're just like banks, we're sensitive to macroeconomic challenges. We're all paying more for the cost of funds today. We don't like that. And the reality, though, is that that's putting strain on our margins, and we'll talk a little more about that. But we are embedded in the ecosystem in the financial capacity community, and the reality is we're focused. We have the same challenges a lot of other folks in terms of staffing and investments in operating systems, et cetera. But basic components of the loan fund. And the reality is the numbers don't lie. For those of you that are coming that are new into this, CDFIs achieved proof of concept a long time ago, okay? Because the focus was very clear. We need CDFIs as a business model in order to be viable, need to prove that they can get money from diverse sources, blend those together, get them out in the street to the right folks, manage it well based on sound underwriting and financial health standards, recycle that money in, and most importantly, show impact, not just show that, yes, we're serving our target market and we're accountable to our community, but we are creating real impact. And so it's just an example of some of the many publications where we're grateful to the academic community and researchers to be basically showing CDFIs have achieved proof of concept. The question, though, becomes, and we'll get into this, that it's not so easy, depending on where you sit, depending on what your goals are, and the fact that we are not depository institutions. And so if you just want to look at it just broad brush, you can see here just between 2011 and 2025, the asset growth, significant, right? Asset growth is driven by federal investments, which continue today, have not been reduced. Private bank commitments through the Community Reinvestment Act, where financial institutions get credit for making investments in CDFIs. Community philanthropy, national foundations, high wealth individual social impact investors are making those contributions. And if you look at just the composition of how it falls out, this is as a 2025 Federal Reserve report, and these numbers are moving because of changes in certification, but 45% are loan funds, 30% credit unions, banks and venture capital, 25%. Credit unions really drive the assets here, but that's just in terms of the composition. And then to give you a sense of the bottom line, which we'll get to here, which is CDFIs are financial institutions at heart, and they have to perform as financial institutions with a mission focus. And you can see here, if we just look at based on data from Opportunity Finance Network and ARIS and the New York Fed, you can see the asset picture right now for small business funds, and that includes micro and small business lenders, housing development lenders, and community finance lenders. And you can get a sense of how those dollars have flowed. Operating loss incidents, you can see that housing developers 4.2%, community facilities 6.8%. The red flag on small business lenders is it's usually much lower, 5-6%. It's because of the economy and situations going on right now where we have to focus a lot of time on portfolio management and shoring up our assets. And that number, as I said, typically looks much lower. But you can see, because of the economy just recently, the overall portfolio growth rate is flattened because of high interest rates and uncertainty in the economy. But you can see with housing development lenders and community facilities lenders, there's still upward growth. Deployment ratio. The reality is that it's a key metric. If you are sitting with $1 million on your balance sheet, you're not going to be very successful asking for more money unless you can leverage that million and with more dollars, but get it out on the street. And so if you've got a 40% deployment rate, that means you got a lot of money sitting inside. And the question becomes, are you really structured to be able to move that money and have impact? And you can see that that's what we're looking at across the board, high levels of deployment. Charge-off rates. Those of you that are new to this may say that must be a typo, but it's not. It's not a typo. Small business, and I know there's a variation. If you're a micro lender, it may be 5% and higher in terms of your default rate, which is still incredibly respectable. But the bottom line is, it's not a typo. It's not a typo because that's where the superpowers of CDFIs come in and provide that careful, flexible underwriting and support to their entrepreneurs, to their homeowners, to the businesses that they're supporting here, so that we're talking about risk mitigation, right? Risk mitigation technique and sustainability. And as you can see, self-sufficiency is the holy grail, but the reality is that larger CDFIs, more varied and diverse CDFIs, are able to increase their level of self-sufficiency. But these are incredible numbers considering the fact that we have to balance public and private money. And so the truth of the matter is there's no expectation that a majority of CDFIs will become financially self-sufficient, economically self-sufficient, because they won't grow to a certain scale in order to be able to reach that. But that doesn't mean that they don't deserve support. Doesn't mean that they don't have tremendous local impact, as we're going to talk about. So just some data there. And just to kind of lay it out just in extremes, because obviously there's lots of folks in the middle. If you're trying to understand that business model a little more, you have lenders that are scale driven, right? They are focusing on earned interest margins. They're doing mixed use commercial projects, affordable housing developments, high transaction volumes. And it's a very different portfolio here in terms of the underwriting, in terms of asset-backed and optimized DSCR, concentration, right? High dollar affordable complexes, commercial charter hubs, infrastructure assets. And they are vulnerable to macro changes in the environment, and especially any changes that are happening within that asset class. So these are organizations, because of their scale and volume and diversity, have been able to become economically self-sufficient. But then, frankly, the majority of the industry is populated more by what I call like the localized niche model, which is subsidy-driven stability. And so these are organizations that may be anywhere from 20 to 50% self-sufficient. They are balancing, competing for operating grants, federal funding, philanthropy, and then be able to leverage that with private sector capital, with bank money. Underwriting is different, right? Character-based metrics, qualitative risk pricing, and really understanding the dynamics of the economy in local neighborhoods. And these lenders are doing startup loans, loans to small businesses that can't access additional capital, single-family down payment debt. But there's a higher risk involved, right? There's a heavy overhead drag per dollar deployed because of the amount of technical support that goes into helping those entrepreneurs and those homeowners succeed. And obviously you're dependent on the vagaries of the public funding cycle, which we just went through last year. And so There are certainly folks in the middle of that. There's not really, this is just two broad spectrums. There are scale-driven organizations that may be dealing with modest losses because their goal is they're higher risk lenders, but they're managing it as best as they can, and they're going to take a higher loss rate, still within industry standards for performance. But you can see that that it varies. The bottom line, though, is that today there's a lot of talk about collaboration, about mergers and acquisitions. You know, CDFIs need to consolidate, get bigger, and and displace some of the smaller shops. And I don't particularly think that's the way to approach this. There are organizations in certain markets coming together and saying, we're both CDFIs. I have this niche, you have this niche. Let's come together and do more for all of us. But the reality is that the sector, the diversity in the sector is something to be celebrated. It's not a hierarchy. It's a complementary network where these models can work together collaboratively. And there are many examples of smaller CDFIs now using the platform of larger CDFIs to do their underwriting and servicing. There's lots of creation and collaboration at the community level, which is a reflection of the fact that we came from the nonprofit space, right? But now we understand that we need to be adopting stronger practices of financial institutions. And so we have an ecosystem of large CDFIs that move markets by revitalizing zip codes, right? And niche lenders that empower individuals by providing targeted support. That's my town over there. I hope you like my town. That being said, those of you that are saying, yeah, Jason, but you're burying the headline, those of you I can see that have been in the business a while, it's a real core paradox, our business. It's a real core paradox because we're doing what traditional banks don't, but we have to stay solvent, right? We're not doing anyone any favors with 10% losses, 15% losses, and not meeting the needs of our community. And so what we talk about in the field is this tension between mission and margin. And so this is where we get into the operational realities of the CDFI sector and those hard truths. Because on the one hand, social impact, that's very clear, our mission, right? And what we're doing and why we're doing it. However, in today's market, it's clear that the funding, the interest, the support for CDFIs is moving towards those that are trying to figure out how to achieve greater impact, how to deploy more capital. Don't have to be a national or regional organization, but can show year after year increasing deployment, increasing net assets, healthy financial ratios, and localized economic impact. We are not charities, right? We are very complicated nonprofit organizations that must generate yield to offset the operational costs and also prove fiduciary competence. And so here's the challenge. You see at the bottom here, if a CDFI focuses too much on the mission, it'll go broke. If it focuses too much on profit, and it just turns into the kind of bank that it was supposed to replace. And so there is that constant balancing act of how we attempt to manage that. Because the mechanics of this are clear. High touch, especially if you're in the small, micro and small business lending market, if you're doing down payment assistance, et cetera. So that's time intensive. It costs money to do that, to create innovative programs like so many of you Working Solutions and so many of other CDFIs out there have created to support their entrepreneurs. But there's the pricing paradox, right? What do we charge, right? Well, we're not going to charge 15% because then doesn't that defeat the purpose, runs counter to our mission? Does that mean we charge 5%? Well, but what about being able to generate revenue over time to feed operations? And so the theory says, you know, Riskier loans require higher rates, but we don't want to create a situation that's untenable for our clients. And so we have to balance that, and painfully have had to, over time, raise interest rates. And with the dictate to our clients, though, that the difference in paying 4 to 6 to 8% interest rate, that is our investment in the support that we're providing your business beyond the life of the loan. And so, as you know, especially in the micro lender space, there's a lot of inefficiency, right? To make a $20,000 micro loan could take the same amount of the same legal compliance hours as a $2 million deal, but it's barely making a few bucks in terms of interest. So that's the squeeze that constantly goes on right now. And the reality is that in today's environment, what we're seeing, both with certified CDFIs that are wondering what's their next step in this environment, for folks that want to get into this business, what I always say up front is, you've got to be clear about what your identity is. Are you a community-based organization that provides lots of incredibly wonderful services to people in your community, and one of those is a loan fund? Okay, that's going to help folks with down payment assistance or emergency loans, and it's a nice program, and you use it for your clients. Or are you a financial institution with a community development purpose? They sound like they could be the same, but they're not. And there is no wrong answer, but that identity, that choice of identity, shapes your staffing, your systems, your capital strategy, your risk appetite, how you move forward. And again, there is no right or wrong, but the question is, what's your identity, and how do you see providing financial capital as a solution to the problems in your community? Is it the driver, and you want to put everything behind driving that, or is it part of the toolkit with the recognition that we're going to have to subsidize it heavily, and as we do our other programs, and still make it work? And so the thing that's come up over and over again over 25 years of listening to people and learning and working with folks is that, like myself, a lot of folks came into this movement from the nonprofit social impact, right, civic society standpoint of wanting to be involved in a movement of change and bringing our skills to it, very mission-driven, community-driven, but not necessarily, bankers, finance people, right? That will balance my own checkbook. And the reality is that as the sector's grown up today, we realize that it's more complicated than that we can focus on the mission and know our folks and know the communities and the programming, but we have to, whether we're small, medium, or large, whether we're going for economic sovereignty or a blended subsidy model and still trying to improve self-sufficiency, there are some universal baselines that I want you to be clear about if you are thinking about getting into this business, okay? And so it changes the frame a little bit. And if you look at this slide, it really captures what I'm trying to say. I describe CDFIs as financial institutions dedicated to community development, right? It's CDFI, but I invert it. And I invert it to make the point that in today's market where CDFIs have achieved proof of concept, the real question is, show me what you can do with it. Show me really how you can use this tool as part of the ecosystem to transform neighborhoods and communities and create tangible, sustainable change. And the reality is, well, CDFIs are financial institutions. And so in order to maintain the trust of investors, regulators, and CDFI loan funds are not regulated, but there are performance standards which take the place of that, and certification requirements. But they have to balance their mission with rigorous operational, financial, and risk management standards, especially given the absence of standard bank regulation. More and more folks are stepping back working with their boards, their leadership, and making strategic investments in loan fund systems, in technology, in creating efficiencies in the lending process, to do automated underwriting, but that is geared towards your underwriting standards, right? To basically say, we are a mission-driven organization, and we're not going to lose touch, but we need to do this faster. We need to do it more efficiently and effectively, because that is going to help make our case for funding that we are building the principles of a sound financial institution. And so everybody knows essentially what that is, right? Because whether you're a bank or a CDFI, it's disciplined underwriting. And yes, we have unconventional guidelines, but they've got to be paired with rigorous expert risk assessment. Financial reporting and compliance has become so incredibly important, not only because of the change in the CDFI certification application, the changes that are coming in the compliance reporting and mechanisms, but the reality is that today's funders want to see that you've adopted best practices and principles in terms of your clear institutional grade reporting, your compliance mechanisms, that are on par with any normal financial institution, and technology integration, right? 10 years ago, there were maybe 3 or 4 loan operating systems out there for a micro lender, a small business lender to buy. I don't know. Today, there's a dozen, maybe more, and there's specialized versions, all because of the pressure that's being placed appropriately to say, we want you in this game. But we need to see that you're making the investments that show us that you're going to be able to scale up. The other thing is that in terms of eyes wide open, where CDFI loan funds are not regulated like by OCC and the Federal Reserve and et cetera, it is very clear 25 years later what a performing CDFI loan fund looks like. Doesn't matter who it's lending to and what the products are. And the markets, but the reality is there are certain, we call them camel ratios, financial institutions. CDFIs are evaluated based on a variation of camel ratios, where we're looking at deployment ratio, we're looking at net assets, okay? The primary structural balance sheet insulation layer required to completely absorb unhedged loan losses without collapse. Net charge-off rates, and these are averages of OFN members and others, not the entire industry, but you're still looking at 5% for small business loan funds, for example. And again, people are just astounded when they hear that, because they think, oh, they must be creaming off the top. And no, we're working with folks that are credit worthy, but outside conventional guidelines, and are going to go through a process to develop sustainable businesses. And so, and there's lots of resources that we can share, and we'll share with you if you want to go deeper into the specific performance standards. But the point is, whether you're the CDFI fund or a bank or a community philanthropy, they're going to underwrite you like you're underwriting, like the underwriting you go through for a home loan or a car loan. They're going to want to look at your balance sheet. They're going to want to look at your pro formas. They're going to want to see that you have been successful over time, continuously bringing in lots of other people's money, getting it out slowly but surely, accelerating growth and impact, and have a sound business strategy to make a difference in your community. So that leads us then to, okay, well, all right, you've talked about we're not depository institutions, so where does the money come from? And again, we're not going into the weeds here. This is meant to be high level, but the anatomy of a capital stack for the CDFI is you're a magician. You are a swami. You have these superpowers of how you're taking capital at different cost of funds and different requirements and everything, and you're trying to blend it all into this package of financing, where net assets equity is 50%, debt capital is 43%, EQ2, which are slow, patient, equitable EQ2 investments, equity equivalent investments, which are kind of long-term debt that revolves. And by the way, for those of you that are saying debt, a CDFI fund doesn't make it by getting funding from the government and community philanthropy. You have to borrow money in order to be able to build that portfolio. The magic of being a CDFI, though, is taking that debt and leveraging it with equity and financing from other actors to be able to build that capital pool. And you can see here, the idea here is senior debt tier, subordinated mezzanine tier, and equity first loss, in terms of, structurally how that works. And again, depending on your CDFI and your mix of that. But it is an art and a science. And if whoever you have on your team, that's the development officer, keep them well fed, make sure they get plenty of sleep. Okay. And so what it comes down to today is how you manage that tension, because you never solve the problem. There's what we call the Robin Hood subsidy model, where you're balancing your portfolio by mixing lower risk, higher margin loans like affordable housing, right, or SBA 504, larger loans, with high risk, low margin loans. Okay. That is where growth-oriented CDFIs have been able to carve out a space and build scale by staying within the ecosystem, but either moving up market or down market to be able to capture opportunities that are there. The traditional micro lender that now lends $150,000, $250,000, $500,000, because there's a need, and the same target market, entrepreneurs in business can't get bank loans. Projects that wouldn't make it without the missing piece of the CDFI stack. And so those growth-oriented leaders have said, we are going to figure out how to do those loans. We're going to build the people, the systems, the staff, the technology to be able to do that. And in doing so, can achieve our mission and have greater impact, because we can broaden our base. Okay. There's layered financing. CDFIs frequently secure government grants or philanthropic donations to act as what we call first loss capital cushion, to protect their loan fund, especially because we have to develop a loan loss reserve fund against potential debt. And so this layered financing allows us to lean heavily into the mission without risking the overall margin. And then there's non-interest revenue, right? We've got to offset the high costs of support services, and we're aggressively pursuing grant funding for operational support. And that's easier said than done. I know all of you out there that will always say to me, Jason, do you know of any new sources of funding? The reality is we're nonprofit organizations, and we shouldn't hide from the fact that as nonprofits, and as part of that structure and that mission, that we do need subsidy. But today, the mantra is smart subsidy. Smart subsidy meaning that soft money, right? That non-interest revenue that is going to invest in our people, invest in our systems, invest in our programs to build our institution so that we continue to be in a place to be competitive for CDFI financial assistance, capital magnet funding, to be in a place where we continue to compete for new markets, tax credits, et cetera. And with our clients today, it's about making that case that as a growth-oriented CDFI, there's always going to be a level of subsidy, but we want to show our investors, our funders, that subsidy, that smart subsidy, is helping us to actually grow our financial institution and have greater impact. And that case statement can then lead to, in many cases, funders will pay for a business plan. They'll pay for a new loan operating system because they understand the cause and effect of making those institutional investments. And of course, paying staff. And so the bottom line here is that when people call me up and they want to, they say, I want to create a CDFI. And I say, okay, I'll give you an hour of my time on my dime, but just understand that I'm going to try to talk you out of it. Okay? And I know people are nodding because of the paradox and the difficulties of doing something which is really quite incredible, that you have over 1,000 organizations across the country and native on Indian reservations and out in the desert in New Mexico and in New York where I live and elsewhere that are doing this day after day, getting money into the people hands that need it. But the bottom line is, for a CDFI, margin is the means, mission is the end. Without the former, you can't serve. Without the latter, you have no purpose. And so while the size shapes your strategy, right, and sustainability sets the standards, achieving both market moving scale and local impact requires the rigorous operational discipline of a financial institution. And for those of you that are starting out, make sure someone in your advisory group, someone on your team has credit, commercial lending experience, finance experience, to be able to help guide those initial discussions about what it takes to become, in essence, a financial institution. And the reality is, once you're up and running for approximately a year and you've made a few loans and you meet the other certification requirements, you can get certified, but again, that doesn't open the door to funding. It gets your foot in, but what gets you all in is demonstrating that you are building a financial institution with a strong, dedicated community development purpose. So that's it, because the reality is we really wanted to focus and give you a high-level overview of what it means to get involved in this sector, and then open it up for questions. And I can see that because we have a lot of friends on here that are running wonderful CDFIs, if they want to chime in on that or add something or take me on, we're all for it. Any questions?
So Ben asks, prior to CDFI certification, does Friedman Associates help standing up nonprofit loan funds, specifically the legal documentation and initial structuring of the nonprofit?
Yes, we do.
Say, funny that you ask that, Ben.
And we are not here to we're not here to sell our services. We're here to talk about eyes wide open what it means to get involved in this business. And as I said, first I'll try to talk you out of it, and then you'll prove to me I don't know what I'm talking about, and then we can get to square one of what it means to begin to create that loan fund, that structure. The way we do it is in the building phases, to make sure under Amy and Nadia's leadership and our team that you're building it to meet the certification guidelines, so you don't have to do that twice. That would be terrible. So you're building something that will meet the guidelines, and get certified. But then again, with our team of industry veterans that have been running multi-million-dollar loan funds, we'll help show you how to design and create that and build that to achieve your community purpose. Let's see. Okay. Operational. Let's see. Grant funding for operational support is a dichotomy, right? It's and I know, especially to you that are in business right now, knowing that, yeah, we can go after grants, and there are certain times where we're going to get that grant, we're going to use it to pay salary because we're still waiting for the SBA or SBA award. We're still waiting for this, for that. And when we originally planned to spend half of that to support salaries and half to buy a new loan operating system or or revamp our policies and procedures, and we understand the challenges that are embedded in there. I recommend a lot of you folks look up Andrea Levere, Levere, who talks about enterprise capital. She's a godmother, one of the godmothers, I'll call her, of this industry, but she's helping organizations make the pitch that it's not just operational funding for operational funding, it's operational funding to make the investments to be a stronger mission-based financial institution that will then that will have a cause and effect in terms of generating higher volume of loans and higher impact, and how you begin to frame that argument about, because just like a business, CDFI is no different in the core foundation it needs to build. We'll send out the slides afterwards to everybody so you can see that. We'll also include some other data sets for you as well. For those of you that are new to the field, you should know that shortly we will be, this is a 3-part webinar series, and where we're going over the high-level operational realities. Amy and team will be talking about the requirements of certification, not what it means to be a performing CDFI, but what are the behaviors and standards that you must meet, that where the Treasury says, yes, this is a mission-driven financial institution, and they deserve certification. Amy's going to run through that, and then we're going to have a 3rd webinar where we talk more about the tools that you need to develop and implement as you're moving forward on your journey. Okay, any other questions? All right, excellent. Thank you for your time. As we said, we'll get everything out for you. The video will be posted on YouTube, and you'll get all the information, and please reach out if you have any further questions. Thanks, Amy. Thanks, Nani, for hanging in there. Man the Q&A deck. Everyone have a great afternoon.
Thanks, everyone.
Thanks, everyone.